Hello, everybody. It's John Llodra here from New Harbor Financial Group for another timely take. These are periodic short form videos that we put out on something timely and hopefully with some actionable guidance for our clients and listeners. We're a handful of days away from the end of the year here, and this is always a time for folks to be thinking about opportunities to improve the tax situation, which we all know is just a handful of months around the corner when we're this time of year. And that's certainly something that we keep very much in mind for our clients as relates to their investment accounts with us. So the natural thing to think about this time of year, and you have up until the last day of the year to take care of this, is what we call and what is referred to as tax loss harvesting or tax loss selling. And really, this is not a complicated thing. It basically is just a way to opportunistically mine your portfolio, if you will, for opportunities to better your tax situation. Now, reality is that no matter how insightful one is when it comes to investing, we certainly try to do our best, but we are far from perfect, and we're going to get some things wrong. And that comes in the form of securities declining in value from the purchase price at which we buy them. And let me first start off with, of course, a caveat to mention that this is not meant to be personalized tax advice. You really should use this as educational and consider your own circumstances, call us directly, but we're not authorized to give tax advice. That's really up for you and your tax advisor. But so all the things I'm going to talk about here have, they don't apply to tax deferred accounts like IRAs, annuities, 401ks, because those simply are not affected by what we're going to talk about, realized capital gains and losses. What is a realized capital gain? Well, what is a capital gain or loss? It's simply the difference between the price you or the cost you purchase something for and the price that you sell something for, or what the current price of that thing is. So a stock or a bond or a security of any sort can be subject to capital gains. And really what you want to do, capital gains are taxed at different rates depending on whether they're long or short term. And a long-term capital gain is related to anything that you've held, a security you've held for greater than 1 year. And a short-term capital gain is held taxed on anything that you've held for less than a year. I'm not going to get into the specifics of the tax rates, but generally speaking, much more favorable tax rates for long-term capital gains than short-term capital gains. But what oftentimes happens is folks have capital gains either because of stocks or other securities that they've held, but also that they've sold during a year, but also can relate to sales of businesses, sales of homes, and other capital assets that are sold for a gain. And it makes a lot of sense to mine one's investment portfolio and other holdings to see if things can opportunistically be sold for a capital loss to offset those gains. Because when it comes to capital gains and losses, they offset each other. And the way it works is like offsets like. What I mean by that is if you have both long and short-term capital gains realized in a given year, and you have unrealized, meaning you haven't yet sold those things on a short and long-term basis, first and foremost, long-term losses will first be used to offset long-term gains that are realized. To the extent that there's still long-term losses left over, meaning you have more losses, long-term losses realized than long-term gains realized, those leftover long-term losses can be used to offset short-term capital gains. And vice versa, any leftover short-term capital gains will be used to offset long-term gains that are realized. Basically, another thing you want to be very careful about is what's called the wash sale rule. And the thing is many folks are reticent to sell things because they want to be in a certain asset class. So for example, many people are sitting on big losses in bond portfolios after the sell-off in bonds over the last couple of years. Even though they've bounced very sharply over the last month and a half, 2 months, they still may have losses. At the same time, and they want to stay in those bonds because they think there's further bounce. Well, you can sell a bond ETF, for example, that you might hold and swap into another one, so long as it's a slightly different index, enough so that it doesn't run afoul of the wash sale rules. You can sell that and buy into another one that has essentially the same kind of exposure. Now, the wash sale rule is you can't buy the same security within a 30-day period. After 31 days, you can buy into that security and still have that loss that you harvested stick and be used to offset gains. Now, very importantly, when you look at the wash sale rules, it it covers not just your own personal accounts over any number of brokerage firms that you might hold them at, but for example, it also includes your married spouse. You want to make sure across that marital unit or across the various accounts any individual holds that you don't accidentally buy into a security that you sold within a 30-day period. Otherwise, that loss will be disallowed, and essentially it's not lost forever. It's just adjusted in the basis. But that's very important to understand. You want to basically take advantage of losses when they exist. If you're expecting a big bounce in something, harvest that loss now, because a bounce in that thing will cause that loss to go away. And you want to use this to offset things that maybe have appreciated in value sharply, and is a good time to sell. So this is a very in-depth topic that I can't do justice in a very short-term video like this, but it's all just a reminder to take the timely opportunity to look at this situation in your portfolios. Certainly, we here at New Harbor Financial are very happy to chat with any client or prospective client about this as it relates to your personal situation. But again, want to remind you, just a few days left in this year to take care of this, and a very sensible thing to do if you can do it. That's it for now. Wish everybody a great day, and thank you for listening.